The argument could be made the top is in the corn market from both a fundamental and technical point of view. However, our fundamental reads on real fundamentals were likely skewed by activity last week that could be considered an anomaly. Meanwhile, the long-term read on real fundamentals remains bullish. This piece could be considered part 2, or part 2013, I've lost count, of what I wrote last week, Confusion in the Corn Market. The latest is a question I've heard through the grapevine. I was visiting with a good friend in the brokerage industry and his customers were adamant that the top was in the corn market. Why? Because they are excellent students. You see, my friend uses what he reads on my website and what we talk about in our phone conversations with his customers, so they know when basis is weakening and futures spreads are collapsing. The market, any market, has to have topped. Beyond my market rules, this goes back to what another friend of mine used to present on grain's golden rule that tells us, first basis, then futures spreads, then futures. A look at the daily chart for the CMDTY National Corn Basis Index, ZCBAUS.CM, NCBI, weighted national average cash price, will indeed make one woozy. The NCBI was calculated at 33.0 cents under May futures last Friday, March 4th, far below the 20.8 cents under from March 1st after the roll from March futures to May took place. Recall from my previous piece how interior merchandisers, those away from the river market, export market, were reporting bins being full with no place to move the corn they were buying. Add to that the fact May futures were rocketing to the highest level posted by corn since mid-September 2012. A side note here, last week's high by the in delivery by still nearby March issue was $8, bringing to mind corn's characteristic round number reliance. But here's where things get complicated, as the incredible rally in futures last week threw the basis market into turmoil. I heard reports of merchandisers rolling cash bids out to July, September, and in at least one instance new crop December, all trying to limit margin risk. The end result were basis bids all over the map, so an index made up of these bids will naturally be skewed. Other merchandisers had pulled bids completely, meaning cash indexes were likely skewed as well, making reverse engineering basis nearly impossible. There was also a group of merchandisers who kept their bid in May but dropped basis dramatically to limit risk. The bottom line is one of our key reads on real fundamentals has been taken away, at least for now. But that leaves us with our other key read of futures spreads, right? Not necessarily. We saw some incredible moves in corn futures spreads late last week, first inverses were strengthening then collapsing, the latter continuing into Monday's session. The natural inclination is to think, again, if spreads are breaking then fundamentals. This is indeed usually the case, but maybe not this time. Think about all the factors discussed in basis being skewed. We can apply those same actions to what was seen in spreads last week, giving us a similar conclusion. We may not be able to trust what we saw in spread movement. Add to that, non-commercial traders were liquidating futures positions rather than providing support with new longs, and the end result was the vacuum trade after contracts hit those big round numbers. May corn had a high of $7.8275 while July hit $7.47 this week already. Here we must remember Horton the elephant taught us, and apply it to futures spreads. An inverse is an inverse no matter how small. And an inverse in a storable commodity is always bullish. From a seasonal point of view, the CMDTY National Corn Price Index, ZCPAUS.CM, NCPI, weighted national average cash price, tends to move lower during March, usually due to increased cash movement ahead of planting season. This marketing year, just past the halfway point, the seasonal rally has far exceeded what is normally seen, leaving the cash market vulnerable to a larger sell-off. Does that mean the top is in the corn market? Maybe, maybe not. Think about it this way. What is going to happen in mid to later April when the cash bushels that have been made available the last few weeks have either been used, feed, ethanol, or exported? Recall my monthly available stocks to use calculation continued to tighten through February, and the rally by the NCPI during the first week of March did nothing to indicate the tightness was loosening much. This means merchandisers should be back in the market later this spring, and available bushels are still going to be hard to find, maybe even harder than they were this time around. For if producers weren't willing to sell when the NCPI climbed to $7.50, what price will it take to shake those bushels loose? Lastly, let me put my technical analyst hat back on. Each month I look at long-term monthly charts to study long-term trends, and if I were to take the title off the NCPI monthly chart, I'd say it's still in a long-term downtrend and likely established a double top this month. From a technical point of view,